Okay, we're going to get going. Thank you all so much for being here. This is the Kaiko research team's first monthly webinar called The Current. We'll provide once a month on the third Tuesday, crypto data insights and trends. We'll really be diving into the most important market events that are happening today. So I'm joined here with the entire Kaiko research team. We have Connor, who focuses on macro liquidity. We have Riyadh, our DeFi analyst, and Desi, our macro expert. And then me, I'm Director of Research at Kaiko. And slight disclaimer, nothing that we'll talk about today is investment advice. I don't need to explain much further, but let's get going. So we're going to focus on four major market trends that have really impacted the entire crypto industry over the past month. The first is banking sector turmoil and the impact on crypto markets. The second is DeFi's reaction to the USDC depeg. Third is the general state of market liquidity. And then finally, macro's outsized impact on crypto. But before we get started, just a quick 30-second intro to Kaiko. In case you're unfamiliar, Kaiko is a digital asset data provider. We were founded in 2014, and we cater for the data needs of financial institutions and corporates. We have four main business lines. The first is market data. We offer tick-level and aggregated data from more than 100, both centralized and decentralized exchanges. We also offer BMR-compliant rates and indices for investable products. 3 is our quantitative analytics. We offer products such as implied volatility and value at risk, which uses our own proprietary methodologies. And finally, the research. This is what we lead, and we'll today be providing research analysis, all powered by Kaiko's data. So a bit more about Kaiko Research. We have 2 research newsletters. We offer a quarterly report, a weekly chart book, and then today's analyst call, which will be the third week of every month. You can actually register for the next analyst call on the same registration page. All of this can be found on our website at kaiko.com. And finally, how does Kaiko Research actually do the research that we do? All of it is using Kaiko's highly granular liquidity data. This is trade volume and liquidity metrics from centralized exchanges and also decentralized exchanges. It includes data types such as market depth, the bid-ask spread, price slippage, and then for decentralized exchanges, we use liquidity events, we do liquidity pool snapshots, and then swap volume. So it's essentially just terabytes of highly granular data. In the research team, we explore this data and we bring you insights. So let's dive into these key market trends. The first one I'll be focusing on is the banking crisis and the impact on crypto markets. So I would say that there is no market event that has been as significant as last week's collapse of 3 major banks. You had Silicon Valley Bank, Signature, and Silvergate. It created quite a market impact in crypto, specifically because Silvergate and Signature were 2 of the most crypto-friendly banks. They had 2 payment networks, the SEN and Signet network, that essentially every trader and market maker and exchange was connected to. This let anyone who had large amounts of fiat currency, the dollar in this case, quickly deploy capital to cryptocurrency exchanges. I know that SEN had about 100 exchanges and almost 900 institutional investors that were part of this network. And so now that it doesn't exist, this presents quite a challenge for cryptocurrency markets, specifically when it comes to liquidity and actually deploying fiat capital onto exchanges. So today I'm going to focus on trends in stablecoins versus fiat currencies. This is a really important question now that there are fewer and fewer fiat on-ramps into crypto. Because the main problem with crypto is at some point, in order to buy Bitcoin, you need to use real fiat currencies, either the dollar or the euro. And to do that, you need to have a banking relationship. So in the United States, banking relationships are pretty much on the rocks right now with the collapse of these banks. And so what's the future of the usage of these currencies on centralized exchanges versus stablecoins, which have grown in popularity over the years? So I'm using centralized exchanges in this chart. I included the 20 most liquid, which also includes FTX historical data. And what we can see is quite a stark trend that even before the banking sector crisis, we already saw that the usage of stablecoins on centralized exchanges has surged just in the past year. In January of 2022, stablecoins denominated just 60% of total trade volume, and today that number's up to 79%. So stablecoins are also already extremely important for the wider crypto ecosystem. Today, fiat currencies account for just about 18% of total denominated trade volume, and then others include cryptocurrencies like Bitcoin, ETH, and then Binance's BNB. So overall, it shows that with probably what we're going to see is this number of stablecoin trade volume is going to increase even more than it already is. But which stablecoins are winners, which are losers? So let's dive into the ratio of trade volume specifically for stablecoins. So this uses, again, the same 20 exchanges. And what I've done here is isolate all stablecoins, the top 4 in this case, which are USDT, Binance's BUSD, Circle's USDC, and then DAI, which is a decentralized stablecoin. And so we can see quite a shocking trend that even when you're looking at stablecoin volume, it's pretty much dominated by just one stablecoin, that is Tether, USDT. Today, 80% of total trade volume for stablecoins is using this. And so we actually see a big interesting trend that's with Binance's BUSD. Back in February, Paxos announced that they were no longer going to issue BUSD. It essentially was the death of this stablecoin. It's still in use on Binance, but it essentially doesn't have a future now that you can't create any new Binance BUSD. So that leaves 2 others, USDC and DAI. Why aren't we seeing much action on centralized exchanges? That's because these 2 stablecoins are mostly used in DeFi. So on centralized exchanges, we have a main conclusion that first, Tether is dominant on centralized exchanges, but also that centralized exchanges account for the vast majority of trade volume in crypto markets. So what we're seeing is risk essentially concentrated into a single stablecoin, whereas even with BUSD, it was a nice counterweight to USDT. And now that we won't have that in the future, it will be interesting to see whether USDC will be able to reclaim some market share. But the main question we want to answer is what's the future of fiat, specifically in cryptocurrency markets? Let's now dive into the fiat percentage of market share. This is looking at trade volume denominated in fiat currencies on the same group of 20 centralized exchanges. I've used the top 14 fiat currencies. Overall, there's in terms of global number of currencies, crypto markets, you can't use all of them. Rather, it's concentrated in mostly the US dollar. We can see here that the dollar has the most volume, except it's fallen since last year. Today, there's about 47% of all trades that involve a fiat currency are using the dollar. And this is a decline from January in 2022. So the second largest fiat currency is the Korean won. This is because South Korea has quite an active cryptocurrency environment. There are some very big cryptocurrency exchanges based in the region, such as Bithumb. And so that's why we're seeing a large ratio of volume for the won. But third is the euro. Today, the euro only accounts for about 6% of trade volume when you're looking at fiat currencies. And so the main question is that in the United States, now that it's increasingly difficult to deploy US dollars on exchanges, now you have to do wire transfers, which can take about 2 to 3 business days. Will the euro emerge as sort of the next dollar, or will there be another fiat currency that emerges? That's something that we need to wait and see. There currently is not a similar type of network as Silvergate or Signature that exists in the Eurozone, but we'll see if another bank comes and essentially is open to taking on new crypto clients. So now let's take a step back. I've shown you all of these trends looking specifically at stablecoins and fiat, but where is this volume actually concentrated? So the trend is quite clear. When we're looking again at these 20 most liquid centralized exchanges, we can see here that Binance is by far the dominant exchange. Binance's market share has absolutely skyrocketed even since January of 2022. Today, it accounts for more than 70% of total trade volume among the most liquid exchanges. Coinbase comes into a distant second place, and their market share has stayed relatively consistent. So what conclusions can I draw from this? First, Binance does not let you trade fiat currencies like the dollar. So the vast majority of volume on Binance is actually denominated in Tether. This means that most trading activity in all of crypto markets is conducted with a stablecoin Tether, just one, and on just one exchange, which is Binance. So this shows that, again, we're seeing a concentration of the vast majority of market activity on one platform. In the future, I think it will be interesting to see what happens with Binance, especially because regulators are paying closer attention, and they're actually getting kicked off of some fiat on-ramps. Just last week, they had to cut off British pound transfers to the exchange, and last month, they actually restricted US dollar transfers to the exchange. So now there's fewer and fewer fiat currencies that you can use on Binance, which actually positions exchanges like Coinbase a lot better. It could be a lot easier for Coinbase to expand overseas and capture a more global user base. So I'm ending this portion, but one last thing I want to bring up is that weekday versus weekend liquidity is something that we're going to pay close attention to. The most important things that Silvergate and Signature did was essentially enable 24/7 liquidity for exchanges, even on the weekends. It was really easy to do transfers. It was automatic, and you could do it at any time of the day. So we already see a divergence in both 2022 and 2023 in trade volume, weekend versus weekday, but we can expect that the magnitude of these differences is going to increase over time, especially because it's a lot harder to transfer funds to an exchange. Banks don't operate on the weekends, and you can't actually get the transfers out. So we're going to see a lot less liquidity. So that's the section on the banking crisis. But next, let's actually dive into one specific market event. As Silvergate collapsed, there were fears around Circle, especially because they had 3.3 billion in this bank. And this created fears of a USDC depeg. So USDC actually dipped to as low as 90 cents. So I'll let Riyadh now take over this part and talk about how DeFi faced a key test.
Yeah, thanks, Clara. Yeah, so even though it seems, maybe old news at this point, I think crypto survived one of its biggest tests ever 2 weekends ago. So if we can take a look at price, okay, thanks. Yeah, as you can see, it dipped below 90 cents briefly on centralized exchanges. And if we can move on to trade volume, so most users don't have Circle accounts, which are necessary to directly redeem USDC. But even if they did, Circle suspended redemptions over the weekend. So this created all-time high volumes on USDC trading pairs that had previously been lightly traded. And then sort of to compound this, back in September, Binance had delisted USDC. As Clara mentioned, this is because their stablecoin was growing quickly and they wanted to promote it. So we can see here that the bid liquidity decreased quickly as people realized that Circle had funds trapped at SVB. And Binance came in and listed their USDC USDT pair, which I think was absolutely crucial in providing liquidity for USDC. And as you can see now, like that pair is easily more than half of centralized exchange liquidity for USDC. But most of the action did happen on DEXs, so let's take a look at that. So here we have like the three most sort of crucial exchanges on Ethereum: Uniswap v2, v3, and Curve. As you can see, they were pretty efficient. There was, of course, some DeFi weirdness with bots affecting price. So you can see some trades at like 60 cents. These were the result of MEV attacks, known as sandwich attacks, where essentially a user is swapping and gets front run by a bot. Then you can also see that there were some trades close to the dollar peg, even as USDC was depegged. And these are also bots, essentially arbitraging between the different Uniswap v3 pools. And then if we look at volumes next, Curve really did well throughout the chaos, with 6 billion in volumes just between the big three stablecoins, that being USDT, USDC, and DAI. So 6 billion compared to Uniswap's 4 billion. And then it maintained that lead for the next couple of days. And basically Curve's mechanism is more conducive to large swaps, which made it like really important for whales who wanted to, get out of USDC. And we can move on to lending and borrowing. Essentially, lending and borrowing rates work. They sort of work as a proxy for borrowing demand. So as the borrowing demand for a certain token increases relative to the amount that is deposited in a protocol, for example, here we have Aave, then the supply rate will increase. So this gives us a cool sort of indicator here. So as we can see, USDC's demand, borrowing demand actually increased as it started to depeg. This is likely because of shorting of the token. So essentially, I can deposit ETH and borrow USDC. By doing that, I'm essentially long ETH, short USDC. And then the rate spiked and quickly decreased again. This was the result of users repaying a lot of USDC loans that they had previously taken, essentially getting a discount on their loan. And next, we can take a look at some of the alternative stablecoins. So here we have 3 stablecoins that didn't have any exposure to USDC. USDT, is not a US-based entity, didn't have exposure, and is, basically the clear beneficiary from any potential, hit to USDC's reputation, sort of as Clara discussed. But then we also have SUSD, which is the native stablecoin for the synthetics ecosystem, and LUSD, which is probably safe to say the most decentralized stablecoin. And again, neither of those two had any exposure to silver SVB, and so they've both seen a sharp increase in borrowing demand. And now I'll hand it over to Connor, who's going to sort of take a step back and look at market liquidity after all these sort of crazy events of the past couple months.
Cool. Thanks, Riyad. Yeah, so crazy few months for or crazy few weeks for liquidity, I guess. It's at the forefront of everyone's mind, whether that be in traditional finance or crypto as well. It's had a few liquidity incidents over the last few weeks. So yeah, and essentially in low liquidity environments, that's when crypto is at its most volatile. There's less support to the upside and downside in terms of prices for crypto assets. So it's a really important metric to keep an eye on. And the metric we use for liquidity is market depth. So for anyone that doesn't know what market depth is, it's essentially when the bids and asks on each side of an order book, it's taking the sum of those bids and asks of orders that have yet to be filled on an order book within a certain range of a price. So for here, we're taking 1% market depth. So that would be 1% above and 1% below the price. And as a gauge for overall market liquidity, we're using the top 10 crypto assets here by market cap, including stablecoins. So we're taking an aggregate and summing the market depth for all of those assets. And as we can see, so this basically chart works as a timeline, I guess, for the liquidity incidents of the last few weeks. Some of them crypto related, some of them not so crypto related. And we can see that at the start of the month, we started at about 600 million of liquidity. And that number dropped to about 400 million as market makers who provide liquidity to crypto exchanges started taking a bit more of a cautious approach as Silvergate started having some issues. And as Clara said, with the Sen network shutting down, that was a big piece of infrastructure for market makers in crypto. And then the next big incident then was obviously SVB, the deposits with SVB, the issues with those, and then signature closing, which was the other big part of the infrastructure for USD kind of settlement networks that were 24/7 that a lot of these market makers were utilizing to send money to OTC desks, to send money to trading firms, to send money to other crypto firms. And with the 24/7 nature of crypto, those kind of pieces of infrastructure are pretty critical to the structure of the market. So what we saw when Signature was closed then was just market makers pulling a lot of orders off exchanges, like basically pulling back all the liquidity on exchanges, and it dropped about 50% overnight, as they came to the realization that basically there was no kind of payment settlement network currently in operation for them, and there was fears as well over USDC depegging, which Riyadh touched on. And so we saw basically just in times of high volatility, market makers react and don't want to get caught on the wrong side of a trade. So they pull their liquidity off of exchanges. So that was the big dip we saw. And the spike then was when USDC repegged, and then it became clear that Circle would be able to satisfy any kind of redemptions on the Monday morning. And as well, the spike coincided with Binance, as Riyadh was talking about, listing the USDC, USDT pair that they phased out a few months prior. So that was an immediate injection of about 60, 70 million of liquidity to crypto markets. Really came at the right time, and then kind of boosted overall kind of USD liquidity. But the issue still remains of payment networks with US exchanges. And we can see in this chart here that it's been US exchanges that have been harder hit from a liquidity standpoint, as market makers on those US exchanges react more extremely, I guess, to the issue that's affecting them the most, which is the USD payment networks being shut down. So we can see there that when Silvergate was closed, there's a near 40% drop in liquidity on US exchanges compared to the non-US exchanges, hardly even had a drop. It was a different issue when Signature was closed. There was USDC depegging. Both non-US and US exchanges had a loss in liquidity, but US exchanges, as you can see, dipped more. So it's been a real tale of basically US market makers on those exchanges kind of taking a wait and see approach and seeing if there's any viable option for a USD payment network. And we can see then in the next chart then liquidity broken down per asset. So here we have a bit broken down into Bitcoin, Ethereum, and different altcoins. And it's pretty interesting to see that the spike in market depth, where it increased like 2x off the lows last week, coincided with the rotation into Bitcoin that we're seeing, and people seeing Bitcoin as, I guess, a safe haven asset in crypto, and Bitcoin outperforming the market. So basically market depth when you're measuring in USD can increase for a number of reasons. So essentially two reasons. So one of those is that market makers themselves are actually adding orders to an order book. And that's a really sustainable way of increasing liquidity. And that's a good sign that market makers are moving, are basically changing their sentiment and adding liquidity to an exchange. And the other way would be if USD prices increase. So that's when the value of the orders that are already sitting on an order book increase in value. And that basically is what we're trying to figure out here, is was this spike driven by a price rally or by, I guess, market makers, a change in sentiment to market makers and more of a willingness to add liquidity. So in the next chart, the way of doing that is the measuring market depth in native units. So essentially measuring native units is when you measure market depth in Bitcoin or Ethereum or whatever the native unit for that token is. And it's a really useful way of kind of minimizing price impact on that liquidity figure. And it really came in useful here to see basically that there was no difference in treatment from market makers of the two assets. So between Bitcoin and Ethereum, they weren't seeing Bitcoin as particularly safer than Ethereum. They weren't rotating or offering more liquidity in Bitcoin. They were treating the two assets as the same. And in fact, both Bitcoin and Ethereum had a loss of liquidity in native units, which is really interesting to see. So we can conclude from that a lot of the BTC kind of liquidity drive was price driven, and that this like kind of rotation and this narrative was maybe more retail driven than institutional, because the institutions that offer liquidity here didn't have any real change in sentiment, and especially a difference in treatment of the two assets. So the next chart kind of follows on that theme of native units as a way to measure market depth, and paints a pretty cautionary picture here that Bitcoin market depth is at basically its lowest point in over 10 months. And it's failed to kind of regain the difference since the FTX collapse. So at Kaiko Research, we coined a term just straight after the FTX collapse about the Alameda gap in Bitcoin liquidity that we were witnessing. And obviously Alameda were one of the biggest market makers in crypto. And once they shut down operations, liquidity essentially hasn't recovered to those levels we've seen since. So it's been choppy since the FTX collapse, and then this new wave of fresh banking fears, new worries about liquidity has impacted Bitcoin market depth and the crypto market in general. So really important in terms of getting a kind of more sustainable like uptrend in crypto prices or crypto markets, that we get this new kind of injection of liquidity that we've yet to see since the FTX collapse. And then in the next slide, kind of just to tie a bow, I guess, on the liquidity section, is to look at volumes quickly and just to get a sense of where we're at right now in terms of volumes. So the good news is that volumes have picked up off of the like multi-year lows we saw at the end of 2022 when sentiment was pretty depressed. But now we're seeing that sentiment has really picked up, activity has picked up, and kind of investors are returning to crypto markets and making trades on centralized exchanges. And if you compare like kind of market cycles, we're showing pretty similar pattern to the trends at the start of 2021, which we all know kind of what came next there. So maybe that's painting more of an optimistic picture. And if we are to kind of see a more sustainable uptrend in the crypto prices like we're seeing at the minute, we'd need probably a fresh injection of liquidity and a pickup in volumes to kind of work in conjunction to kind of boost crypto markets. And as I said, we've yet to see that injection of liquidity in crypto markets as of the moment. So yeah, that's the liquidity section, and I can pass you over to Desi now to recap a pretty crazy month in macro.
So hello everyone, I'll talk a bit about the macro environment and how it has impacted crypto over the past weeks. So we'll start with the banking story, then I'll look into returns a bit and the shifting correlations. So we can go to the first chart, which basically shows the main story in macro right now, which is the banking story. I won't spend too much time on this, but essentially what happened is that 3 banks in the United States collapsed within days. And this is because they have been investing their deposits, so short-term liabilities, into longer-term debt securities. And of course, in the meantime, the Fed was tightening aggressively at the fastest pace in 4 decades. So yields, which move inversely to prices, went up within 14 months from 0 to 6%. So basically, this has created a classic duration mismatch. With banks, when they were faced with deposit withdrawals, they had to basically sell at a huge loss. So in the United States, it was mostly a liquidity issue. Then it kind of spilled into Switzerland, with Credit Suisse having some trouble. And what we can see from the chart is that Bitcoin has been mostly declining up until the Fed injected liquidity into the banking system. Both the Fed and the Swiss National Bank intervened, adding emergency liquidity. And since March 12th, Bitcoin has been surging, despite the fact that we are still well into banking turmoil, and there is a lot of uncertainty around what's happening tomorrow at the FOMC meeting. So why is Bitcoin rallying? And we can maybe move to the next chart. The main reason for the current rally is essentially changing US Fed monetary policy path. So this is the 2-year Treasury yields. The Treasury yields are basically a proxy of the short-term interest rate set by the Fed. And we can see that we had a huge repricing in Fed monetary policy expectations. Yields dropped by 100 basis points in 3 days between March 8 and March 13, which is the largest decline since 1987. So it has been very sharp. But essentially, this is what is driving the market. It's a changing liquidity outlook, and Bitcoin being very sensitive to liquidities, as all risk assets is benefiting from this. There are other reasons, of course. The new Fed emergency program has been seen by a lot of analysts as a form of quantitative easing. We saw last week that the Fed balance sheet increased by 300 billion. And so a lot of people were quick to say that it is a reversal of the quantitative tightening we had over the past 10 months. I won't go into it. Basically, it all depends on what happens tomorrow. If we have a less dovish than expected action, this could wait on the current rally. Then I wanted to look into Bitcoin's performance over the past 3 months, and these are the risk-adjusted returns since the start of the year of Bitcoin and Ethereum and other traditional assets. It's essentially the Sharpe ratio, which is risk-adjusted for volatility. And what we can see is that Bitcoin and Ethereum have been outperforming other equities since the start of the year. So in March, it has been mostly macro-driven, but we have had some crypto-specific stories since the start of the year. I'm talking, of course, about regulation in APAC, with Hong Kong pushing to become a digital asset hub, which has been quite positive for crypto. It kind of coincided with the China reopening narrative. Then, of course, we had the tightening in the United States, which went the other way. But ultimately, it has led crypto to decouple and to diverge from the Nasdaq. And this is my last chart. I wanted to talk about correlations. Over the past year, crypto has been very correlated to tech equities. The average correlation between the Bitcoin and the Nasdaq was around 60%. And this has shifted this year. Correlations with tech equities has declined and is currently hovering around its lowest level since the collapse of FTX. And if we exclude FTX, it's actually the lowest level since the end of 2021. It's around 20%. At the same time, it is interesting that in March, we have had an increasing correlation with safe haven gold. So highlighting maybe a safe haven narrative that's also driving prices a bit. So with this, I'm going to give the floor back to Clara and to questions.
Thank you, Desi, and thank you all. I think this was a really great summary of the 4 major events that are currently driving crypto market activity. It's quite something that Bitcoin has rallied up to 28K and has the best risk-adjusted returns relative to all traditional financial assets, despite big issues with the banking sector. So now we're going to do some Q&A, and I see we have about 4 questions. Okay. So I'll start with, we have, what is your outlook on Lido staked Ether and CBETH going into the ETH Shanghai upgrade? Do you expect price arbitrages to close completely, net of fees? I'll let Riyadh handle this. He has looked extensively into staked Ether.
Yeah, thanks for this question. And I think it's like there's a lot of debate around this right now, especially like, you know, if people are going to sort of rush for the exits once withdrawals open up. You know, I wouldn't expect that the price arbitrages would close completely. I would expect that they would still exist, largely because like the withdrawals won't be processed all at once. So there's sort of differing opinions on, like, you know, results of like how many people try to withdraw, and then, you know, how long it'll take to actually receive the underlying ETH. So I think because of sort of the staggered nature of it, the price discrepancies will continue to exist. And on the Coinbase part, I would say probably not. You know, I think it's much easier for a lot of people to use a centralized exchange, especially one that they trust like Coinbase, to access staked Ether. Whereas like if you wanted to get staked ETH, you know, you'd probably have to download a crypto wallet and then like familiarize yourself with like how all the DeFi ins and outs. So I think Coinbase will sort of continue to have a good hold on this market, and will be able to keep their fee pretty high.
Great. So next, we'll move on to Christine. Hello, Christine. Question for Connor. What sentiments do you think are driving the ETH BTC cross now, and any upcoming events you think will impact the cross?
Cool. Yeah, great question. Well, yeah, but it's basically a tale of 2 stories, really, especially Bitcoin is kind of, you couldn't dream up of a more perfect storm for Bitcoin than the last few weeks. Like, it's basically the perfect marketing strategy for Bitcoin. It's nearly so simple. It's like brilliant. Like, Bitcoin's still proof of work. It's really like advertising itself as this like like hard money that can't be touched, that's really decentralized. And as I said, you couldn't think of a more perfect narrative than what's going on in the bank with the banks right now. People maybe are starting to realize that the USD in some of these banks is not as safe as maybe they thought it once was. And then Bitcoin obviously has this narrative of just being this decentralized like store of value that no one can touch. So it's really been a great few weeks for Bitcoin. And then on the ETH side, I guess something that's kind of weighing on the ETH price, the biggest overhang is probably the Shanghai update that's due to come soon. A lot of people think this will bring kind of significant sell pressure for ETH, or at least that's the narrative. I'm not sure I fully buy into that narrative. I think I saw stats that like 75-80% of ETH, of people depositing like staked ETH were underwater from the price that they deposited at. So I'm not sure the sell pressure will be as big as a lot of the kind of narrative is hyping it up to be. But it kind of just, but that's basically, it's a story of two narratives really. Bitcoin is really like boosted by its narratives at the minute, whereas ETH has this overhang that Shanghai updates might lead to more selling. I don't know if anyone else has any thoughts on that. I guess it's on the two narratives.
Sounds good to me.
Yeah.
Cool. So maybe we'll move on to Marcin. Do you believe USDC would still have depegged if SVB collapse had happened during the week on a Tuesday? That's a great question. And 2, have you ever done an analysis of what would need to happen for USDT to depeg? The rumor goes that SVBF tried to depeg it. Interesting. So I think I can answer number 1. So on USDC, that's a really good question. On Tuesday, what did have happened? So USDC is pretty illiquid on centralized exchanges. There were only 8 currency pairs that traded across all exchanges that had a USD-USDC pairing, which means that essentially all traders were for a fiat off-ramp. And so they flocked to these 8 relatively illiquid fiat currency pairs for USDC, and they completely bombarded it with sell orders. And it instantly caused the price to dip on the only real trading pairs for the dollar. So this essentially served as a real-time exchange rate for USDC, not what you're seeing in DeFi. In DeFi, you can't trade the dollar. So on DeFi markets, you saw a huge dip in the 3 pool, USDC, USDT, DAI, but that ultimately doesn't reflect the real exchange rate versus the dollar. So that's a good question, is if this happened during the week, maybe these markets would be more liquid. However, I just think that in general, USDC isn't that liquid on centralized exchanges. So I think it would have happened even during the week. So part 2, have we done an analysis on USDT depeg? Again, I want to redefine a bit what depeg means for a centralized stablecoin. It essentially means that are you able to withdraw and redeem your stablecoin for dollars. Sure, you have a spot market that you can trade Tether versus the dollar, USDC versus the dollar, but at the end of the day, all you really care about is the centralized stablecoin issuer able to continue with redemptions, do it quickly, and also be able to, I guess, account for billions of dollars of redemptions. So if USDT depegged, it would happen on a spot market, or it would happen on whether Tether would sort of restrict redemptions. So I don't think it will happen on a spot market. I think the likeliest is it would happen on a spot market, and then Tether could halt redemptions. But for now, I don't think there's a risk in the near future. Okay, so then we have another just general liquidity outlook. I'll let Connor answer that.
What's your liquidity outlook of the next 6 to 12 months? As I said, we're basically as sentiment has been pretty grim now for the last few months in crypto markets, bar maybe we've seen obviously the pickup in volumes. We've just yet to see that pickup in liquidity correlated to that. So I think for any kind of injection of liquidity to happen, first, as I said, we need to see these USD payment rails get back up and operational. So I've seen stories of European group, BCB group that are looking at filling the gap and they already offer like Japanese yen and euro payment rails in Europe and Japan. And they are considering going over to the US and filling the gap for USD. So I think it is a matter of time, in my opinion, that we will see like someone else offer these payment rails in the US. And then obviously we need a friendlier banking environment as well for crypto. So we need a few kind of banks to raise their hand. I saw an interesting CoinDesk article this morning that was interviewed some of the like 20 top banks, and they were all basically like pretty hush-hush on whether or not they were going to take on crypto deposits. Some of them flat out said no, some of them refused to answer the question, which I thought was nearly more interesting. It's nearly like something a bank maybe mightn't want to come out and say at this moment that they're accepting crypto deposits, when for like the banking environment is so fragile right now. But I think as kind of the market forgets about that over the next few weeks or months, we could see a few banks raise their hand, take on more crypto deposits, and that's only going to help liquidity, especially, as I said, on the US exchanges. They're the ones that have kind of suffered the most lately. So I'd be pretty optimistic about liquidity looking past, I guess, looking past a month in the timeline you've mentioned, 6 to 12 months. And hopefully some of that Alameda gap will be recovered.
Great. Thanks for all the great questions. I think we have a few more minutes so we can actually keep going. So let's talk about Victor's question. How was the impact of the banking events on liquidity, funding rates, and open interest for perpetual futures? So we actually just covered this in our Monday newsletter. So I'll let Connor, who made this chart, take this.
Sure, yeah. So we saw essentially, like, as I said, this rally into Bitcoin was also reflected in derivative markets as well. We saw open interest rise by, I think it was about 1.5, 2 billion worth of new open contracts were open on derivative markets for Bitcoin. And that wasn't all just price driven as well. So similar to the market depth I was talking about in native units, you can also look at open interest, which is the amount of open contracts and derivatives that have been opened. That also gets affected by price, but if you break it down in native units, you can see the actual new addition of contracts. And we saw, I think it was about 50K worth of Bitcoin contracts were open in derivative markets. So it's very similar narrative to what's happening in spot markets as well, is that there's this rotation into Bitcoin, people starting to speculate again on Bitcoin, a kind of renewed interest in Bitcoin, purely because, I guess, how simple it is and how much it contrasts to the lack of confidence going on in banking at the minute. So yeah, and funding rates, we saw funding rates move positive for, I think we talked about a sample of 4 top tokens, Bitcoin, ETH, BNB, and Sol, all moved positive around the time of the banking crisis, which was interesting. And then BNB, which was probably more interesting, actually, the funding rates for BNB moved particularly negative. So I was kind of trying to come up with a reason as to why that might be. The best I could come up with was I saw an article saying that this Binance Recovery Fund that was tipped to transfer about 1 billion of BUSD into Bitcoin, ETH, and BNB. It seems they've actually transferred that into other stable coins, Tether and TUSD, I believe. So that mightn't be that. So that it seems to be weighing, I guess, on derivative investors' minds more so for BNB than it is for Bitcoin and ETH. That was the best reason I could come up with for BNB, lower funding rates. But yeah, similar narratives in summary to what's going on in spot markets. We're seeing in derivatives right now.
Great. Now let's see what else we have. So we have proof of reserves, a question from John on proof of reserves. It seems to have stalled across the market given the lack of auditors willing to participate in the space and the lack of consistency across exchanges. How do you see proof of reserves evolving? So that's a great question. It's something that Kaiko is actually working on. So we have an exchange ranking today that essentially looks at about 25 different parameters on an exchange, from governance to liquidity to regulation, et cetera. And so we're actually going to soon incorporate proof of reserves into this exchange ranking. It's extremely important, but I think it's a good point that auditors, they're afraid to touch crypto companies right now. And it is going to be a problem to get audited proof of reserves. So honestly, I think it's not fully clear how the industry will respond to that. I love the transparency we're already seeing from exchanges. We're getting a lot of great data, and it seems like there's a genuine desire to be more transparent. But again, without the auditor, it's going to be a big problem, and you can't actually prove anything, especially because proof of reserves is essentially just like, without it being audited, it means pretty much nothing. Okay, from Charles. Does Kaiko have any opinion outlook on smart contract development, DeFi on top of BTC? How would this impact DeFi on ETH? Good question. Riyad, do you want to take this one?
Yeah. Well, I would just say I don't think Kaiko as a company has an opinion here, but like personally, I think it's cool. I mean, it gives a new element to Bitcoin. From like my like DeFi analyst perspective, it provides a whole sort of new area, and you can sort of watch the development of like the infrastructure in real time. I mean, I saw people were trading NFTs using like Google Sheets, which is just cool and weird, and I think it's pretty interesting. Obviously, the community is sort of split on it, but I think it's cool. And the impact of DeFi on ETH, I would say right now it's pretty minimal. I wouldn't expect that it would be siphon away any activity from ETH at the moment, especially as like layer twos are picking up. I think they can sort of all coexist at the same time.
Great. And then finally, last question. Looking at trailing liquidity, do we see decoupling in ETH and BTC prices? So I'm actually going to let Desi answer this. She recently commented on correlation between Bitcoin and ETH. Desi, what is your outlook just on general ETH BTC dominance? Oops, I finished the question. So go for it, Desi.
Well, Bitcoin and Ethereum have been very correlated over the past few years, but ultimately, with both assets maturing, they will start to decorrelate because more value will enter into Bitcoin, and we see rising use cases. There is already evidence that Bitcoin's use case as a store of value is rising because the percentage of long-term holders is rising. So ultimately, with the maturing of the space, they will decorrelate. But for now, Ethereum and Bitcoin are quite correlated, moving in the same direction. And the reason for this is that most investors are treating them as risk assets and crypto assets. And of course, during sell-offs, they're treated the same way.
Great. Well, I think we've gone past the 45 minutes, but thank you all so much for joining Kaiko's first analyst call. Subscribe to our newsletters. You get all this analysis and more. And also you can register in advance already for the next analyst call happening in April. I sent the link in the chat box. And yeah, reach out if you have any questions. We're always happy to give commentary, charts, analysis, especially to media. I know there's some journalists on the call. But thank you again, and we'll see you in 1 month.
Thanks, everyone.
Thanks. Bye.